folks, I'm Chris Mathis, Chief Currency Strategist for Bank Pips International. Welcome to our first installment of our weekly FX brief. Now, Bank Pips is a brand new trader training and market analysis service. We're literally launching in just a few days now. And even though we're a new service, our team is very experienced. I personally have been trading the spot Forex market for going on 18 years now. I'm a former hedge fund trader, current prop trader, and I've been in the training side of the industry since 2007 with multiple programs. Now, our goal here at Bank Pips is to take you outside of the retail way of thinking and introduce you to the institutional way of thinking when looking at the markets. And that simply means we step outside of just the technical analysis box, outside of the basic fundamental box, and we really analyze and teach you to analyze the scope of the market when looking for trades. And then obviously that comes with a very structured way of approaching the market. The biggest separation between institutional or bank traders and retail traders are 3 points: education, structure, and information. And we try to help out with all three of those things. Okay, so anyway, without further ado, let's go ahead and get into the markets here. So we'll go ahead and get started with our brief. And we're going to start with the economic calendar because we want to know what's ahead of us, what's coming up for the week. This helps us to understand when we're likely to see more volatility in the market. Now, this is the first week of August, and this is really a time to be careful at this point. August is the thinnest traded month of the year, and this year it's especially dangerous, in my opinion. The reason it's dangerous is obviously we have everything going on right now with the COVID pandemic. We have, when we start to look at prices here, we have some extremes taking place. We're coming into some significant liquidity areas on certain currencies, and we're just at a time, if things hit during a lower liquid market, it can create violent moves. So I think what I'm going to do is we'll go over the calendar here, look at what we're seeing coming up for this week, where we could potentially see some volatility, and then I want to give you a quick little background. This might be a little bit of a longer brief today because I want to give you some background about things that we've been looking at lately. And when I say we, I'm talking about my current program that we're merging into the Bank Pips program. But we've been following these things we're going to talk about for quite some time, and I want to get everybody caught up, and then we can move on from there. All right, we think the Antipodeans are going to have a big week this week. We start things off here with the RBA. No change expected to the cash rate, but the market's going to look at that RBA statement. And then right behind that, we're going to see the New Zealand employment figures. Then we also see New Zealand inflation expectations. So we have some big things coming up this week for the Antipodeans. And also, we're always looking at risk tone when we're looking at currencies like the Aussie and the Kiwi and the CAD, because those are impacted by the overall risk tone in the market as high beta currencies. Then also coming up this week, we'll have the Bank of England, their rate statement, policy summary, official bank rate votes. Obviously, that can create some volatility, although we're not expecting very much from that at this point. We'll also get the RBA Monetary Policy Statement later in the week, so another reason to expect a little bit of volatility on the Australian dollar, one of the Antipodean currencies. And then at the end of the week, we'll have NFP, U.S. employment, which is always potential for some volatility. We also get Canadian employment there as well. So we have quite a few things coming up this week as far as data events that can provide some volatility. But the major focus of the market continues to be on risk. And that's not going to change for quite some time. As long as we're dealing with this COVID pandemic, as long as we're dealing with governments still shutting down parts of the economies, we're going to have to look at risk. And equities markets have been way out of touch with what's happening on the ground with the real economy. And that's not always surprising because that's not the major driver of the equities markets. But we do see them typically line up better than what we're seeing right now. right now we have some really extreme things going on. So let me go ahead and get into this review now of things we've been watching with the equities markets, and this will give you an idea of why we're equity bears. Doesn't necessarily mean that the equities markets are going to come down tomorrow, okay? But we are overall, broader picture, bearish the equities markets and bearish risk in general. We're just waiting for the opportunities to be able to exploit that idea. So with that, let's just go ahead and have a peek at the equities markets to see what's happening at this point in time. So I'm just going to open up, and this will be equity futures here. So we have the equity futures markets up. This on the far left here, obviously, is the Dow, and there's been a bit of a it's been really interesting here with the Nasdaq, because the Nasdaq obviously can continue to drive higher. The S&P is now in this same cycle. It still hasn't pushed back through the highs of the initial large decline that we saw back in February and March. Neither has the Dow. So we've had a non-confirmation here. And that can be looked at two ways. It can be looked at as the Nasdaq is leading, and S&P and the Dow are looking to catch up, or it can be looked at as a non-confirmation, where the Nasdaq is just topping last. We've already seen the tops in the S&P and the Dow. Now we've remained neutral on this aspect of it. While we broadly think that equities are going to have another significant decline, whether or not we're doing it below or above these recent highs, we're not trying to really determine that. We're waiting for the start of the breakdown to take advantage of it. So we're open for either of those. Now, because historically, we've seen the Nasdaq at times has topped last. During some of the last major crashes that we've seen, the Nasdaq topped last. So we've seen these non-confirmations in this aspect, where the other U.S. markets top first, Nasdaq continue to push a bit higher, and plus, what we know about the Nasdaq, we have some. There's really large cap stocks that are driving this right now. When you go into the internals of the equities markets, and you look at the breadth of the markets, there is really a huge disconnect between about 5 large companies in the U.S. The other thing that we know is we've had millions of amateur traders coming into the market. Since we've had these lockdowns and all the unemployment and these stimulus checks have gone out, we've had millions of amateur traders. They're called Robin Hooders, if you see them in articles, have come into the markets, many of them with long-only accounts. Okay, that in itself, in the thin market, is a recipe for disaster. That typically does not end well for the small amateur traders. And just to give you an idea of how significant it is, we literally had traders, amateur traders, buying into stocks of bankrupt companies. I mean, just think about that for a minute. Buying into stocks of bankrupt companies. There was recently, there was a lot of smaller amateur traders that had bought into, it was a stock in the cruise line sector, thinking that things are opening back up, travel's going to open back up, and they dumped a bunch of money into it. And when that thing started to crash down, and they actually this group of traders went to court, pleading to a judge, so they tried not to be wiped out. Sentiment has been extremely bullish the equities markets. We look at the equity put call ratio. Just recently, it hit 20-year lows, which means there's an explosion in call options. Right? If we have an explosion in call options, these folks are all betting on buying into the equities markets. There was another interesting point put out by Goldman, that they did a study, and the options, there was actually more volume in the in equity options than there was in the underlying instruments, in the underlying security itself. and that's one heck of an anomaly. Okay, so it's very serious, folks. And we're coming into August again, the thinnest traded month of the year, low liquidity. It's dangerous. We believe it's dangerous at this point to be long risks, to be long equities. Now, if you happen to get in early, great. But folks that are looking to try to buy in now, we think it's a very dangerous endeavor. We still have new folks coming into the markets, and now, just from a risk-reward aspect, there's way too much downside risk in equities. There's just not enough upside potential at this point for what's going on to justify getting long at this point in the market. So I want to go around just look at some things to kind of highlight and let people see visually why this is so out of sync. First thing I'm going to do is I'm going to look at global yields. Okay, these are 2-year yields. We have U.S., German, U.K., obviously France, Japan, New Zealand, Australia, Canada. Weekly charts. All right, I mean, just look at yields all the way still. Matter of fact, yields topped out in November of 2018, and this is why, with the service I currently work for, we were actually projecting the equities market's decline, a significant equities market decline, to come into the market well before COVID was even an issue. This goes back into November, December of last year, where we started to warn about it, and in the beginning of this year, we were really warning clients about it at that point. I'll explain that a little bit here as well, but we saw yields top out in 2018. As a matter of fact, when you look at the markets globally, the equity markets and the U.S. equity markets, these are the only markets that have gotten back above the 2008 highs. Okay, you don't see that anywhere else. You don't see it in bonds. You don't see it in currencies. You don't see it, and even when we look at the economics, global growth, inflation, we don't see, nothing has gotten back above those 2008 points, except for equities. One of the major reasons we were looking for an equities decline going back into the end of last year was because we looked at equities as being a largely liquidity-driven rise. Okay, but I digress. Let's take a look at what we're seeing now in the markets. So I want to look at a couple of things that we looked at yields, and typically, when yields are this far off what we're seeing happening with equities, that can be an issue. Let's go over here and look at the S&P, and this is the put-call ratio here, down the bottom in this blue. Now, the put-call ratio, as you can see, we're fairly low here, but this point right here, okay, this point right at the beginning of June, we put in 20-year lows. Okay, this means that there's an explosion in call options. All right, and typically when we get down to these levels, that's where we start to see different corrections at different points. And here you see it led into a big correction here back in 2018. Another point when we get down here, another big correction. All right, coming in. You can see where we were at with the put-call ratio right here. Okay, as we get into prior to the crash. All right, major crash here. And you can see as we've been rising, obviously this put-call ratio is continuing to move lower. We hit the 20-year low here, and we're still very low, even as these markets rise. Okay, this is showing a fairly one-sided market right now. This is the 10-year, 2-year spread, okay, U.S. spread. Typically, this will run opposite, okay, counter to the equities markets. You can see as we're moving down here, equities continue to rise. You can see here during the crash, down the bottom here is the S&P. So here is our significant crash, and see the big rise in the 10-year, 2-year. Now, during this entire rise, we've pretty much hung right up here in this same area. Okay, we're not seeing this come back down. Okay, it's hanging right up here in this area. Okay, this is another bearish factor for the equities markets. Now, obviously things in the bonds market right now are a little bit out of whack with all the central bank interventions and things like that. But still, we typically that correlation stays pretty good, especially if it gets really out of whack. Then we see a rebalancing come into the market. This chart here shows the S&P and U.S. consumer confidence. And as you can see, equities typically run with consumer confidence. Okay, look at what's happening right now. Consumer confidence obviously fell off of a cliff here. Equities did as well, but equities have bounced all the way back. Nasdaq's made new highs. We're getting close to the S&P getting up near the highs before the crash. And now, consumer confidence is still down here, and is actually turning back lower with the second wave that we're dealing with. Okay, more shutdowns, more people out of work. We're seeing consumer confidence turn down again, yet equities are staying up here. That's a big divergence and a significant development. It's a big deal. Let's look at the growth idea. Now we know that growth isn't really a primary driver of the equities markets overall. There's obviously it's going to have an impact. You'll see what I mean when we look at the chart here. So let me just go ahead and pull that chart up. I mean, this drop in growth is so ridiculous and so big, it actually threw the chart out of whack here. So if I go back, there you go. You start to see this is the S&P down here again, and this is the quarterly growth numbers. And so you could see by looking at this, here was the big decline back in 2008. Equities markets came down, then we had the big boost higher. Equities started to travel higher, and then equities continued to go. And this is what I mean when I talk about liquidity-driven market. We weren't seeing it on growth. Growth was fairly stagnant. It started to pick up a little bit. It wasn't terrible, but it wasn't representative of what we were seeing in the equities markets. Right? Equities just continued to go, and this is what growth did, fairly sideways overall. And we saw this on a global scale as well. Now we have this. It's a huge drop. And look at equities. I mean, we're up here near the highs. So we have growth fell off a cliff. We have consumer confidence fell off a cliff. These are things that should impact the equities markets in a different way. And plus, so now when we look at the equities markets, we see the one-sidedness of with the call options and all the new amateur traders coming in, and the fact that the breadth of the market, where we're seeing that it's really 5 major companies that are really helping to keep. And now, don't get me wrong, there's been days where the breadth has been, we've just seen rises in all the stocks. But overall, if you were to take those, the FANG stocks, essentially, and compare those to the other stocks in the index, you would see a huge difference. Okay, a huge gap. The other stocks outside of those aren't anywhere near the highs at this point. And now what I think is the most telling of all of this is the actual flow reports. All right, so we don't have the new one yet, I believe. I'm just going to check, let me refresh this just to double check that. Actually, we do have it. So we have it from 7/29. So this is that's the weekly. Let me check the monthly. Sorry. Not the monthly, we still don't. Okay, I was wrong. Anyway, if we go back, and as of June 30th, so the month leading into that, so the month of June, North America, you can see here, this is flows into the bonds market. Okay, flows out of equities markets. Look at the global. Flows out of the equities markets to the tune of about 12.77 billion. Flows into the bond market, 79.34 billion, and into money markets. Okay, this is not a sign of a healthy rise. This is safety. From a global perspective, this is safety. This is money into bonds and money markets, both safety. Let's go back and look at the previous week here, which is up to 7/29. So this is more recent just from a weekly perspective here. Again, globally, look at all the flows into bonds. 16.87 billion into bonds. Equities has outflows. 3.05 billion in outflows from a global perspective. Again, this is not a market that is saying, hey, we're looking to take on risk. This is a market moving into safety. Now, we spent a lot of time looking at risk tone and equities because that's the major focus in the market right now. So when we're looking to trade, we're obviously going into the currency market, and this week we're looking at potentially a big week for the Antipodeans, like I said, the Aussie and the Kiwi. I also think we have a big week coming up very soon. We'll see if it starts this week, but for the U.S. dollar and the euro. Now, first, we're turning bearish on the Aussie broadly. The Aussie has continued to recover really strongly. It was one of the biggest hit. The Antipodeans both were some of the biggest hit during the crash. They were also some of the biggest ones to recover. We saw the most volatility there. Part of that was liquidity. We moved so fast into a strong liquidity level. Saw a big bounce. The Bank of or the Reserve Bank of Australia, the RBA, handled things a little bit differently than some of the other central banks did, and that gave the Aussie a yield advantage, which helped it rise. Obviously, we were seeing commodities rise as well with the fall of the dollar, and equities and continue to rise, which is also a positive. All of these positive developments continue to keep the Aussie one of the strongest currencies, even in an environment where growth and economic numbers on a global scale were just absolutely horrible. But now we see the tide starting to turn. And this is, we are obviously bearish risk, as we talked about. But right now, what we're seeing on the Australian dollar itself is we're seeing it come into major resistance. Okay, so we're coming into major liquidity levels. We have resting liquidity sitting here after a big, strong run. I'm actually going to go start with the Aussie. Start with the Aussie Swiss. We'll start with the Aussie Swiss here. I like the Aussie Swiss, Aussie Yen, because these are you're pairing a risk currency with a safe haven currency. And here, as you can see on the Aussie Swiss, we're moving into a major level right here. This is testing a major area of resistance. Okay, where we stopped at right here. This is something we were watching as this market was pulling back into it. And you can see, this goes back several years. We can go back all the way into 2015 when this is a significant level here, all the way across. And more recently, you see this little balance area right here. This is where the market was also called a value area, and it's a little bit of a fight back and forth here with the bulls and the bears. A consolidation area, then we had the breakdown. We came right back to it, this is very typical price action. Now we've come back into this resting liquidity, and we're getting the reaction here. I'm going to go down to the 4-hour chart and show you what we identified on this particular cycle. It's something we love to see, especially at these major levels, as we had price diverging momentum indicators. This is where we're getting into the technical aspect of things. We've talked about some of the fundamental and intermarket things. This is something we love to see. This sharp decline right here was perfect, both the lows. So now we have what we're interpreting at this point is either one down, two-wave setback, or an ABC potentially. Either way, it calls for the probability of a lower move in this case. The retracement on this, you can see, came right to the 79% fib, which was also, if you just do a Fibonacci expansion measurement here, you can see it came right to equality. Okay, so that's a 100% move, very symmetrical, with the initial rise, corrective setback, equality move with the first rise. Okay, nice confluence area here. This is one of the setups that we like to see, price moving higher, MACD cycling lower at a key liquidity level. The sharp decline and then the corrective move gives us an idea that we look to trade and targeting our extension or, again, equality in this case. Or if we're looking for a broader move, we can go ahead and put in a target for that too. So we really like the Aussie Swiss at this point in time. This is something we've been tracking for a couple of weeks. We would like a trade on this. Also the Aussie Yen. Actually, we're already in the Aussie Yen. So anyway, these are things that we look for. You can see how we put it together. We're looking at the broad scope of the market, at everything that's going on, not just one thing. We're not just going and looking at moving average crosses or things like that. We want to understand the markets. We want to understand what's happening, what's likely to drive flows, and that's going to give us a much better edge to apply our technical edge when we get to that point. Okay, because this is the last thing that we really get to. We want to know the underlying situation. That's going to help us interpret this a lot better. Okay, so Aussie yen. This is another one. You can see this little box was actually potentially a sell area on this 4-hour. But so we had a rise to a new high here. This was a little bit different than the Aussie Swiss. This one actually did continue to push up a little bit higher. And then we had a bit of a more significant breakdown. So far the market's here. I'm going to go down to the hourly chart. Well, I'm going to back up here in a little bit so you can see the resistance as well. But here's our sharper decline extended cycle, so this gives us a bearish outlook in the near term. After this cycle, 3-wave rise, 3-wave fall. It looks like a flat developing here. For those of you not familiar with Elliott wave at all, 3-wave rise, 3-wave decline to a slight new low, which is called an expanded flat. We would expect a 5-wave rise in C, something labeled A, B, C. And the C wave should be the final move of this corrective cycle, and then we should see another decline. Once this cycle finishes, that should carry us to new lows. All right, so that's the Aussie yen. But also, when I back out of this, let me just get rid of this and back out to the weekly. This is the key, folks. We're looking when you're trading in or around major liquidity levels, and understanding liquidity is going to help you a lot with this as well. And understanding how to identify levels. And we're not just talking about swing points here. We have other tools that we look at to identify significant levels of liquidity, where the market is defined as value areas before, and these are really areas that we come back to a lot once the markets break down. These are also levels that you can use for your entire, you can build your entire trade strategy around these levels as far as targets, stop losses, entries, everything. So it's a little bit outside the scope of this video because we're obviously just kind of going over the broad look in the markets and some potential opportunities that we like as far as general direction for currencies here. But Aussie yen, after moving into this strong level of resistance, i.e. Liquidity level, we do like, if we're not finished here already, we do like this breaking down even further, correcting this entire rise. Okay, and that would be the minimum expectations for a correction. If this rise right here is corrective, then we can obviously see this market move down to new lows. And if we see a significant breakdown in equities, we would expect this to move down to new lows as well. For now, we're taking the more conservative approach until we have some clarity in other places, and we'll just look at this cycle to at least correct this initial rise. Okay, so let me go back again to the small degree time frame. Since we are already looking at this as an extended cycle and a corrective rise, we would already look for a downside move from near current levels and start to target extensions of this initial decline. All right, what else did I want to talk about? I know we're getting a little bit long here, so Aussie dollar is another one. But let me start with the dollar here first, and this is something I think is important. Now, one of the things that I saw, and we've been talking about for the past couple of weeks, is the market's kind of shifting sentiment towards a weaker dollar, right? And obviously, if we're expecting equities to come down and risk to come down, the dollar should rise. The dollar as a safe haven is the most liquid currency on the planet, so it's the favorite safe haven overall in extreme times. So we have a broader bullish picture on the dollar, but what we're looking at right now is how to determine when this current cycle is going to end, and we do believe this is getting ready to come to an end. Let me go back to the higher degree time frame so we can really look. You see we've kind of marked off this little area in here, and this is because we were looking at this cycle and we were expecting this pullback. When we were back here in this little consolidation, we were expecting this decline, and we declined even further than we were kind of expecting to here. But that's okay because we don't just enter in this kind of a scenario. We don't just enter when this market's pulling back. We want to wait to see this market stop, and we want to wait to see the turn. We want to wait to see an impulsive cycle on a smaller degree time frame. So we're not waiting for a big move on say the weekly or the daily chart, because obviously once that big move comes, it's too late to get into a trade. But we look at the smaller degree time frames to get an impulsive cycle to give us an idea. It's time to start trading in line with this bigger picture. So we were looking for this to happen, and we're still looking at this as the same as we're looking at this as what we think is an expanded flat correction. It's very deep, but right now that's okay. Everything else kind of lines up. Now, um, we want to look at the euro too, because we think this is where we're going to be able to take advantage of this particular opportunity is in the euro dollar. And we have multiple reasons to suspect that this is coming to an end. So let me go over to the euro. We'll just jump over to the euro, and I want to start with this is the same pattern that we see. See the weekly here. Now the reason we're looking at this as either an A or a one down is because this looks like a flat, this overall cycle. Again, for those of you familiar with flats, this looks like a three-wave rise. Okay, that came right to the 127 extension, and then this decline looks like a fairly symmetrical three-wave decline, followed by a 5 rise. So A, B, C, 3, 3, 5. Let's do a couple measurements we like to use. This is 127. Okay, so if we take this first little rise right here, here's our corrective setback, and we moved right towards that 127 area here. Actually, I don't even think I drew that properly. There we go. So right into the 127 area, and when we look at the decline from this rise, this three-wave decline, it's very symmetrical. It's a perfect equality move almost. So we have the decline, pull our back to the correction. This is 100%. So we have equality with these two cycles, and then the 5-wave rise. So we're looking at this as an ABC flat, or an expanded flat correction, also called an irregular flat correction. Then we have this decline, which is either a 1 or an A. Very similar to what we just looked at with the dollar index. We're looking at this as potentially a flat. So this little diagonal ended this cycle down. Then we had the A wave rise, B wave decline, 5 waves up in C. It's very deep, but we're coming right into that 62% Fibonacci retracement. Now, this is all technical stuff. Let's go and look at some other things that we want to see. Now, obviously, one of the fundamental reasons that people are looking to stay long the euro at this point is because of the deal that was just agreed to in Europe when it comes to the recovery fund and things like that. So, but that's fine. But we believe a lot of that was mostly priced in going into it. Expectations were that they were going to come up with a deal, and so we think the market largely priced most of that in already. Now, the only thing that could continue to keep it propped up is if there is now less of an expectation of some more breakups in the eurozone. But right now, we don't think that's that's going to be a huge focus. Obviously, the market has a lot of other things to think about right now. Okay, so a couple things I want to look at. I'm going to come in and look at yield spreads, and this is the euro US dollar. And look at what's been. Now, we did get out of whack with yield spreads back here a little bit. We can typically diverge with spreads here with the while they typically run somewhat in line, we do get some divergence here at times. So, but what we're seeing right now is with this strong rise and yields just kind of staying sideways. The spread's staying very, very sideways at this point, which is telling us we're very likely overextended. This also looks like an extended fifth wave cycle on the C wave of a flat. So we're looking at an extended move here that's stretched. It's really stretched. Let's go to. I'm going to go back here, and now obviously we're coming into this is a pretty significant area that we're at now, and we want to see if we break back down into this area here over the next week or so, because that would be a significant development if we reject this liquidity area and we start trading back into this one here. That will be significant. Now, what we're looking at in the euro is potential for an unwind. And we're going to jump over to COT data here for the most recent data, and we'll look at a couple things. I'm going to start with the U.S. dollar because this is the less dramatic one. Now, the U.S. dollar, as far as large speculators, is net short. Large speculators are net short the U.S. dollar, but I want you to look back here over the past more than 10 years. that the dollar doesn't stay net short very long. Okay, each time it comes down into here, we see it rise back up. Okay, we see it rise back up. It doesn't stay net long for very long. Okay, so we're now net, I mean, it doesn't stay net short for very long. Now we're net short again, and once again, we don't see a reason for the dollar to stay net short for very long. So it's significant that we have shifted over to that net short area, and we've been there for a few weeks now. But the most extreme one is the euro. I mean, just look at these all time. And one thing we noticed about last week was the fact that we had small speculators at all-time highs in positioning, in long positions. Okay, this is fairly extreme, folks. We haven't seen this. Right now, we have large speculators at all-time highs in long positioning. We have the commercials at all-time shorts. And we have small speculators, and they've been, for a couple weeks now, we've been at all-time highs for positioning, so that keeps increasing. All right, so we have a very, very crowded position in the euro, which is, and especially when we start to see large speculators up like this, excuse me, small speculators up like this, that starts getting in danger of an unwind. Really in danger of an unwind here. Okay, so just something else I wanted to show here from a positioning standpoint. Positioning is something we really want to see. We want to understand it, because this gives us a really good idea of how strong a move can be. We know if we have extreme positioning, then any kind of change to that sentiment can create an unwind, and that can create a very, very big move. We also like to look for divergences in what's happening with spot and what's happening with positioning. That can give us an idea. For example, right here, as spot price kept coming lower, 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 positioning continued to move higher, higher in this case, and that's something where we look for reversal. We go down to our charts and we look for, divergence setup or whatever, a setup that we like to see off a significant liquidity area, and we look to take advantage of it. But okay, anyway, we're 37 minutes into this video. I don't want to keep you guys. We've gone longer. This won't typically be this long. We had a lot to cover here in this first video. So hope you guys appreciated the video. Hope you appreciated the analysis. Maybe get some ideas that can help you with your own trading decisions. And come check us out at bankpips.com, folks. You won't be disappointed. The course we're putting out is going to be second to none. You're going to learn all of this stuff and much, much more. A really professional way of trading, and you're going to learn from people who have actually traded, institutionally, for hedge funds, who've really managed money and just have a lot of professional experience in this market. Thanks for watching, folks. Truly appreciate it. You guys have a great trading week coming up. Don't forget to subscribe to the channel. Click the like button on the video. Share it with whoever you want. I'll see you guys next week. Take care, everybody. Cheers.